So I just wanted to do a quick video on a options trade that I did a few weeks ago. It was really successful, and part of it was probably lucky and by accident. I think that I was reading some good technical analysis. However, I think the move that ended up happening was like really severe and volatile, which helped my trade, which I wasn't planning on it being that good and that fast. But I definitely wanted to go over it, make a video, because I want to just keep talking about it and remembering all of these good trades that I have. I've saved a bunch of charts and journal notes about it too. So here's Walmart. And what I liked about Walmart is for a while here, for over a year, it was making a really nice range where the top was, pretty much 150 or 152, somewhere up here. So 150 was the high, and it had basically hit it 4 times. And then the bottom, you could argue, was anywhere around 135 to as low as, 127 here. So there was a couple different support areas. I would say this 135 ended up looked a little bit better, more fresh. But then this one down here at 127 was pretty decent too. So what I like about this is this looked really similar to the IWM failed range breakout that it did last year. If we look at IWM here, if we zoom in here, you can see that for almost the whole year of 2021, it was in an even better range, right? This is way more clear and precise. And then this was a big deal. It broke out, you had some good volume, and it went pretty high there, and then was pulling back. And a lot of people were getting long again. So people were getting long here, and then they were getting ready to use this as new support. Well, a good rule of thumb is if you leave a range by quite a bit like this, and then you end up coming back into the range and legit come inside the range and confirm that you're back in the range, more times than not, it goes from one end back to the other, and it can kind of go there pretty fast too, because all these buyers now are trapped, right? We had new buyers here, and then we had new buyers here. And so as soon as it comes back into the range, all these buyers are now selling, and then shorts are also coming back in, and then price goes down to the bottom here, and then now people think it's a good deal again. Buyers that were down here are going to get back in. But then you can see how this started a cascade of top to bottom, and then it goes even further and breaks outside the range, and now we have a breakdown and a trend down. So it's a pretty legit pattern, and it's a pretty cool pattern, and it's over a bigger time frame. So that's why it works better for like swinging or options. And in this case, it's a down move, so you have to use some kind of options to short it. So when I go to Walmart now, I was looking at this the same way. Walmart broke out of the range. This was in April, and this was when the Qs and the stock market and the SPY were potentially turning into a bear market, or were selling off. So to me, I felt like this was a really good setup for a failed breakout. Here's Walmart breaking out. Meanwhile, most of the market was trending down. And so I felt like if this could get back under, this would be a nice short, just like IWM, back to the bottom of the range. So that's what I did. And somewhere in here, actually I have it saved on what day I did it. Oh my gosh, it doesn't save the day. Hold on. Okay, so on May 3rd, which is the day after this red candle. So the day after this red candle wicks down back into the range and comes back above, I entered it, or I got into an options position that was a directional options position, meaning I was going to make money if it went a certain direction, and that was down. So what I did here was I knew that this had the potential, if I was correct, and if price was going to come back into the range, I knew that it had the potential to be a big move down, whether it's to 135 or 127. I didn't, I didn't intend on it just doing a small move down and then coming back up, or even halfway down to the middle of the range. That wasn't my setup. The setup was failed breakout, gets back into the range, and then completely goes down to the bottom. I didn't know how long that was going to take, and so I went for an options strike date that was 2.5 months away. So it was July 15th. And so what I did was I bought a put, which is basically you're paying money in hopes that price goes down to that strike price. And that strike price was $130 down here. So I sort of went in between 135 and 127 and went for the psych number of 130 here. So I bought a put down there. But the thing is if you just buy a put by itself, it can be expensive. So I think that by itself was like $300 or $400. And I didn't want to pay that. If I was correct, I would have made it all back and a lot more. However, most of the time, if you just buy a call or buy a put by itself, you have to pay that debit for it. And then most of the time it doesn't get exercised, and it just closes worthless. And so what I did to mitigate that amount, that expensive price, was I sold another put further down. So when you sell a call or sell a put, you make credit on it. You're selling that, so you make money immediately. And this is a common strategy. A lot of people do this. That way, you don't have to spend as much money, but you still have that directional. You still have that directional trade, and you still have the potential to make some really good money. It's not as good as just buying a call or buying a put by itself, because you sort of have limitless reward with that. And when you do what I'm doing here is, and you sort of cap it off with that sold put. So you're capping off the reward. But if you do it correctly, you can also have a really good reward too, and then pay a lot less for it. And that's what I did. So I bought a 130 put right here. 130 put for July 15th. And then I sold a 115 put for July 15th. So together, instead of paying, $300-400 on this put, I made some of that back. I made about, I think this was like $350 to purchase it, and then this ended up being like $260 that I would make. So basically, the whole thing cost $80, and that was my max risk, was $80. So like I said, they cancel each other out. This costed $80 more than this, and then that way I only was spending a max $80, but then had the potential for quite a bit. And the max would have been $1,400, and that was if price came down and then closed right here. So as long as it didn't hit the sell put and it stopped right before, that would be the max amount I could make. But anything underneath 130, and I was golden, and I was going to make some money. I was going to make that $80 back and then some. And then the further down it went, the more potential I had to make up to that $1,400. And I had 2.5 months to do that because these options are decaying every day. And so this was May 3rd, and I had 2.5 months. I thought this might take a while. You know, I didn't know when it was going to break and then how long it was going to take. I felt like once it broke and got in it, it might take a month or two to come all the way back down. I really didn't know that. I didn't have that back tested or anything. And so, but I got lucky here because about 2 weeks later, they had earnings, and leading up to the earnings, price was already getting back inside the range. And then they ended up having really bad earnings, and that set up this huge gap down, which I believe that whether they had okay earnings or bad earnings, it wasn't going to come back outside of the range here. So it was probably going to start gapping or trickling down here. But basically it happened so fast. It happened 2 weeks later. So I had a 2.5 month options set up. However, within 2 weeks, it had gapped down. And you can see here the low of this day was $130. And because it was so fast and so volatile, that increased the value of both of these options. So when volatility goes up, all of the options, puts and calls, they all go up. And in this case, it was volatile and it was super directional this way. So this 130 put really increased in value, and then so did this, but this one did quite a bit more. And so I held on to it because I liked how it closed near the bottom, and we got another gap down and another move down. And I ended up getting out. I ended up closing this position at $122 here. So I ended up making like $750. So almost like a 8-9R trade, which normally for options, an 8 or 9R is a home run. You normally just make like a 1-to-1 ratio or 1-to-2 because options have a good chance of hitting, especially if you're selling them. But you normally don't have that good of a risk reward. So had this gone down and taken a while, and I would have gotten down in here, I would have made money as well, but probably wouldn't have made near as much. Probably would have just made $100 or $200. But in this case, it came down so fast, and I got out of it down here, made that, whatever it was, $750, I think. Had I waited till it got down here, it was worth more. However, because there was still so much time left in those options, right? We still had 2 months to go. It wasn't going to hit its max, even though it came right down to where I said would give it the max amount of reward. Because it came down here so early, it wouldn't give me the max amount. So I think the max amount would have been somewhere around 1,000 right on this day. So I could have definitely made a few $100 more. But it needs to stay down here longer, and then as it gets closer to the strike date, this sold put will deteriorate, and this will be worth less. Meanwhile, this will still be worth some, and then that will give you that higher amount. So anyways, I just wanted to go over that and just kind of repeat myself on what I did so I don't forget it. I think I did a good job of like using technical analysis to find a big range and seeing a setup that has already happened recently, seeing a stock that, Walmart and some of these other blue chip stocks are a lot of times are the last ones to start selling off, because a lot of times people will put their money into, Walmart and Apple and some of these stocks that have been around forever. Well, maybe not Apple, but like Walmart and just these stocks that have been around forever. They'll put money into those while the stock market is while the growth stocks are going down. And so I felt like I combined that technical analysis of this really big range, failed breakup, with Walmart being sort of the lagger, a stock that was eventually going to sell down with the market. It was just delayed. Both of those ideas combined, and then using IWM as a sort of a draft and a map on how to do it. And I ended up getting a home run trade here in only 2 weeks. I mean, I could have, I guess I could, and that was just one option each. So one bought put and one sold put. If I would have done 10, I would have made, $7,000 and risked like $800. So, and also before this had happened, Amazon had negative news on its earnings. So there were about 3 things that worked together for me that set up to be a good edge trade, I believe. So that's all I got. Thanks.